Welcome to this week's Market Perspective, where we are going to check in on financial markets and the economy. If you are new to Vector and would like a review of your financial plan and investments, go to our website and click Start Here to get started. Now let's dive in. First off, the recent stock market surge. The broad market, measured by the S&P 500 index, hit a peak for the year in late March, then declined by about 5.5%, hitting a low for the year in mid-April. Since then, the market has recovered to that decline. So why is the market increasing? Well, part of it, we believe, is related to recent corporate earnings reports. 80% of companies have now reported earnings for the first quarter, and broadly speaking, corporate results have been better than expectations. On average, earnings have been more than 7% above analyst estimates. Next up, the Goldilocks jobs market. Recent job data currently presents a Goldilocks scenario where conditions are neither too hot nor too cold. Unemployment rates have stayed historically low, and job growth has been robust without overheating. The Employment Trends Index published by the Conference Board suggests a slight slowdown in job growth in the latter half of this year. Another data point to bring in, currently the Bureau of Labor Statistics reports an unemployment rate of 3.9% for April, which is low. Small Business Optimism Index. Data from the National Federation of Independent Business indicates that small business optimism fell in March to its lowest level since 2012. Inflation was identified as the primary concern among small business owners. April's more optimistic numbers came in higher at 89.7, marking an increase over the prior period and ahead of expectations. Next up, Producer Price Index, or PPI. This reflects the inflation experienced by manufacturers and suppliers. Data released on Tuesday this week showed PPI increased more than expected. A rising PPI suggests future increases in consumer prices as measured by CPI, or Consumer Price Index, indicating that inflation might not be subsiding as quickly as some thought. Going back to markets, let's put the recent decline and subsequent recovery into perspective. Historically, a 5% decline on average occurs about every 51 market days. 5% declines are really not all that uncommon. In case you're wondering, a 10% decline occurs about every 172 market days. That works out to about once every year and a half. Markets will go through periods of advances and declines. Importantly, it's not about predicting the timing of these movements, but rather having a plan in place for when markets go up or when markets go down. If you enjoyed this market perspective from your team at Vector, please share and subscribe to our podcast, Well Balanced, on Apple and Spotify.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.